Bitcoin adoption has faced significant hurdles due to widespread misunderstandings about its nature. The term cryptocurrency industry has led many to assume Bitcoin is primarily a currency like the euro, dollar, yen, or shekel. This association triggers skepticism, as people know Bitcoin isn't legal tender, making it tax inefficient for transactions. Moreover, there's the perception that Bitcoin isn't favored by governments, further complicating its acceptance. Consequently, these misconceptions have hindered the broader adoption of Bitcoin despite its unique potential and value proposition.
Bitcoin adoption has been significantly held back by a widespread misunderstanding of its true nature, primarily due to its association with the term cryptocurrency industry. This terminology leads people to assume Bitcoin is just another currency, similar to the euro, dollar, yen, or shekel, a medium of exchange. Consequently, their immediate reaction is to view it through the lens of traditional currencies, focusing on its limitations. They think, it's not legal tender, so trading it is tax inefficient. And it's not my government's preferred currency, so there must be regulatory risks. This misinterpretation obscures the real value proposition of Bitcoin. Unlike conventional currencies, Bitcoin offers unique qualities as a store of value, often compared to digital gold. Its decentralized nature, limited supply, and strong security features set it apart from fiat currencies, making it a compelling asset class for long-term investment. Additionally, Bitcoin's potential for significant appreciation, driven by increasing adoption and institutional interest, further distinguishes it from everyday currencies. By understanding Bitcoin as a store of value and an innovative financial technology, rather than just another medium of exchange, individuals and institutions can better appreciate its potential benefits. Recognizing this distinction is crucial for overcoming misconceptions and fostering broader adoption, allowing Bitcoin to fulfill its role as a transformative asset in the global financial landscape.
Subscribe our channel and press the bell button to get our video notification. And like the video.
An ETF launched in Hong Kong illustrates how regional financial systems manage Bitcoin investments. If you buy Bitcoin through this ETF, the Bitcoin is not custodied in the United States. Instead, it is held at a regulated bank in Hong Kong as preferred by the local financial system. This means that Hong Kong investors, institutions, and companies can funnel money into Bitcoin via the Hong Kong ETF. Rumors suggest that ETFs will soon be available in mainland China as well. These ETFs would be managed by Shanghai-based financial institutions with the Bitcoin custodied in Chinese mainland banks, possibly in Shanghai. With 1.5 billion people in China, there is significant potential demand for Bitcoin. The Chinese government does not object to its citizens or the country becoming wealthier. They favor wealth accumulation. However, their primary concern is to prevent individuals from moving more than $50,000 in capital out of China annually.
An ETF launched in Hong Kong provides a clear example of how regional financial systems manage Bitcoin investments. When you buy Bitcoin through this ETF, the Bitcoin is not custodied in the United States. Instead, it is held at a regulated bank in Hong Kong, as per local financial regulations. This setup allows Hong Kong investors, institutions, and companies to invest in Bitcoin through the Hong Kong ETF. There are rumors that ETFs will soon be available in mainland China as well. These ETFs would likely be managed by financial institutions based in Shanghai, with the Bitcoin custodied in Chinese mainland banks, possibly in Shanghai. Given China's population of 1.5 billion people, there's a significant potential market for Bitcoin investment. The Chinese government does not object to its citizens or the nation accumulating wealth. They are generally supportive of economic growth and wealth creation. However, their primary concern is to prevent individuals from moving more than $50,000 in capital out of China annually. The introduction of these ETFs could dramatically increase Bitcoin's accessibility and adoption in China, one of the world's largest markets. By facilitating Bitcoin investment within the confines of local regulations and financial systems, these ETFs could help integrate Bitcoin into the broader financial landscape of Hong Kong and China. This development underscores the potential for regional ETFs to play a pivotal role in the global adoption of Bitcoin, catering to the unique financial environments and regulatory frameworks of different countries.
The real significance of ETFs is that they solve major issues related to credit access, compliance, accounting, convenience, and reporting. We can expect to see different ETFs in nearly every city or country around the world. For example, if Saudi Arabia wants to keep Bitcoin within its borders, they will likely have an ETF in Riyadh. Similarly, the UAE might establish one in Dubai. This trend is already underway, with 34 ETFs currently holding over 1 million Bitcoin collectively. As this trend continues, we can anticipate the proliferation of ETFs globally, with each country adapting to its unique financial and regulatory landscape. In Argentina, for instance, where capital export restrictions are stringent, the logical solution would be an ETF with Bitcoin custodied in an Argentine bank. This ensures compliance with local regulations while facilitating Bitcoin investment. As these ETFs spread, they contribute to a significant network effect. When investors in China, for instance, buy billions of dollars worth of Bitcoin, it will drive up the price of Bitcoin in global markets, including New York.
The real significance of ETFs is that they address key challenges such as credit access, compliance, accounting, convenience, and reporting. This makes investing in Bitcoin much more accessible and manageable for both individuals and institutions. We can expect to see ETFs being established in nearly every city or country worldwide. For instance, if Saudi Arabia wants to ensure Bitcoin stays within its borders, they will likely establish an ETF in Riyadh. Similarly, the UAE might set one up in Dubai. This trend is already in motion, with 34 ETFs currently holding over 1 million Bitcoin collectively. As this trend continues, we can anticipate a global proliferation of ETFs, each tailored to the specific financial and regulatory environments of different countries. In Argentina, for example, where capital export restrictions are strict, the logical solution would be an ETF where Bitcoin is custodied in an Argentine bank. This setup ensures compliance with local regulations while facilitating Bitcoin investment. The expansion of ETFs worldwide will have a profound impact on the Bitcoin market through a significant network effect. When investors in countries like China buy billions of dollars worth of Bitcoin through these ETFs, it will drive up the price of Bitcoin globally, including in major financial markets like New York. This interconnectedness highlights the powerful influence regional ETFs can have on the global Bitcoin market, enhancing its accessibility and driving broader adoption. By addressing local regulatory and financial challenges, ETFs are poised to play a crucial role in integrating Bitcoin into the global financial landscape, further solidifying its position as a valuable asset.
Subscribe our channel and press the bell button to get our video notification. And like the video.